Hey, it's tax season, and people everywhere are in the process of preparing using the new tax code that was passed last year. And of course, everyone's looking for those advantages to reduce or eliminate taxes, especially in retirement. And there's ways to save a lot of tax dollars, and let's face it, taxes saved means more money in your pocket. Find out how during today's show. Hey, welcome in, everybody. Good Saturday morning to you. This is the Wealth Guardians radio show. I'm your host, Doug Rae, and I appreciate you spending a little bit of your Saturday morning with us. Bryce Payne's here with me in the studio today. Bryce, what's going on, bud?
Not too much. Looking forward to some nice weather here.
Amen to that.
No more rain, maybe.
Spring is finally here.
Flowers are looking nice out there.
Hey, man, before we get into today's show, we have got to just pause for a minute and go back and reflect on a very important 10th anniversary. You know what I'm talking about?
I'm afraid I don't.
Hey, Producer Matt, let me bring you in here. Do you know what I'm talking about, 10th anniversary?
No, I don't.
Actually, we're a little bit over, about a week over. It was, let me give you a hint. It was March the 9th, 2009.
Okay.
Oh.
You know, Bryce?
High point of the market?
Low point of the market.
Low point of the market.
That day, I'll tell you what, this show was in its infancy back then. We started this radio program in the fall of 2007. It was a live show back on WSJS back then. And as soon as we started the show, things hit the fan pretty quick. And I'll never forget waking up at 4 o'clock in the morning on Saturday morning doing my show prep and driving up to Winston to do the show. And the reason I did that is because the feds, they closed the banks at 5:30 on Friday. When they went in and they took over a bank, that's when they did it. So it wasn't until the early morning we found out what banks were closed. So our show kind of started out with a death roll call of these banks.
Always a good light note to start on.
And I tell you what, it was unbelievable. We would bring up the USDebtClock.org, and it was 10 trillion back then. But I'll never forget, I was in my office on March the 9th, 2009, and I was watching one of the business shows. I forget which one, CNBC or Fox Business. And the morning started out like most mornings, with the market just spiraling down. And somewhere in the afternoon, I guess around 1 or 2 o'clock, the spiral started to slow. And this still gives my hair on the back of my neck rise. Do you know what the intraday low on the S&P 500 was on March 9, 2009?
No, I can't recall that.
666.
Wow.
Yeah. The mark of the beast.
And that's when people had enough.
And at that time, I looked up and I looked at the TV screen and I saw the S&P number hit 666. It stopped dead, and then it started going back up and up and up. And today we sit at over 2,800.
That's amazing.
Yep. Yeah. 10 years ago, man.
Long bull run since then.
10 years ago. All right, so let's get into today's show.
Let's do it.
Yeah, we're talking about taxes and so forth. And, Bryce and I are part of the Rae Financial Group, a firm I founded several years ago, primarily, specifically specializing in retirement planning. And, there's two powerful truths about your finances in retirement. Number one is what got you to retirement is not necessarily going to get you through retirement. And this one, the second one, is even more important. Losses mean more than gains in retirement.
Yeah, and folks, if you're listening to us for the first time, what we do at the Wealth Guardians is we create personalized written retirement income plans for our clients so that they and you can enjoy the retirement lifestyle that they've earned, you've earned, and that's important to you all. And we want to help you retire the job and not just the paycheck. And most importantly of all, we practice as fiduciaries, which means we are required by our licenses to make recommendations that are only in your best interest, not ours. And not everybody else does that, and so you want to look for that, fiduciaries.
All right, guys, before we get started, let me, as I customarily do, salute all of our military, our veterans, and our first responders. Thank you so much for your sacrifice and your service. We greatly appreciate it.
And Doug, I'll point this out. Next week, my wife and I and my mother are meeting my uncle and my niece up in Arlington for the 50th anniversary passing of my father. So all the remaining of his family is going to be up there to mark the 50th anniversary, and we'll be around all those people who have given the ultimate sacrifice for our country. So to them and the families out there, thank you all for your service.
He died in an Air Force jet, didn't he?
B-52.
B-52.
Yep. All right, well, let's get started with this morning's show. It's safe to say, Doug, that most people out there hate taxes and want to do everything possible and legal to minimize or eliminate those taxes. And folks, if that doesn't sound like you, then you can probably go ahead and change the channel, because what we're going to talk about today are ways to discuss specific strategies available to you, particularly in retirement, to help mitigate and eliminate your taxes in retirement.
You know, Bryce, Will Rogers had it spot on when he said the only difference between death and taxes is that death doesn't get worse every time Congress meets.
That's right.
You know, all kidding aside, every time they put a tax on, they almost never take it off. I remember the last tax they eliminated a few years ago was a tax they put on your telephone bill that actually was initiated to help pay for the Spanish-American War.
Is that right?
Yeah. They finally took it off maybe 5 or 6 years ago.
Oh, we're finally getting rid of that debt. Good.
Oh, yeah, absolutely. But anyway, taxes are here to stay, unfortunately, and right now we've got an opportunity in front of us because of the tax code change, and we do a lot of tax efficiency retirement planning. You know, in my opinion, our nation's debt, we talked about the USDebtClock.org, and, back in 2007 when we started the show, it was at $10 trillion. Now it's at $22 trillion. And rising. And I have to tell you, folks, I believe tax rates right now are probably the lowest they're ever going to be in our lifetime. It's just a mathematical problem. And let's take advantage of it while we can. I think the tax rates are going to be in place for several years to come. So we got a few years to take advantage of it. And the more money we can get into tax-free vehicles, the more tax efficient and the better off you're going to be. And it's all about tax-efficient planning. We always address this with our clients.
We do.
Let me ask this. Are you up to date on strategies that you can take advantage of right now? You might have heard a few, but probably not everything we're going to discuss today. So let's get started.
All right. Well, we're going to talk about several different tax strategies, but the first today is the tax advantage tool that we're going to talk about is the Roth IRA. A lot of people know about it. It's one of the more popular ones, but it's still worth talking about.
Yeah, very popular and commonly used in retirement planning because of the tax advantages. It's different from a traditional IRA because it allows you to pay tax on the seed instead of the harvest.
That's a good way of looking at it.
Money in a Roth IRA is going to grow tax-free, and it can be used tax-free and passed on tax-free to your beneficiaries. And tax-free is a very good thing.
Last time I checked.
There's two types of Roths. There's a contributory Roth and a conversion Roth. So a contributory Roth is funded with contributions. That has an annual limit, either $5,500 or $6,500, depending upon your age in 2018. But for this year, we've actually got an increase to $6,000 and $7,000. So to contribute to a Roth, you have to have an earned income below a certain level, but you can still make a 2018 contribution to either the traditional or the Roth up until April 15th of this year. So you still got a couple weeks, folks. And you have to use last year's contributions guidelines. The other type of Roth IRA is a conversion Roth. And the nice thing about a conversion Roth is there are no income limits anymore. There used to be, but not anymore. Anybody with pre-tax traditional IRAs or retirement plans can convert part or all to a Roth IRA. Then it's going to grow tax-free and taken out tax-free by just using the simple rules. The only downside is you got to pay tax on that conversion. And the amount of tax owed depends on the tax bracket that you're in for this year. And let me give you an example of how this strategy works. Let's say, for example, you're in you have $50,000 after deductions. That's taxable income. That's going to put you right in the 12% bracket for 2019. But if you're married filing jointly, that 12% bracket's going to go all the way up to $79,000. So now you got $29,000 of room left before you get into the next bracket. That means it's smart to take advantage of that bracket and fill it up with, say, a $29,000 Roth conversion. Now, obviously, before you do something like this, I want you to talk to your financial advisor. I want you to talk to your tax accountant and make sure it's the right thing for you, because the other change to the rule is this year there's no more mulligans, no more do-overs. It's called a recharacterization. In other words, once you make the conversion, it's permanent. So if you want to find out more, just give us a call at 336-391-3409. We'll have that chat with you and see if it makes sense for you.
Happy to help you out. Okay, Doug, let's talk about our next one, next tax advantage strategy, IRS ruling 2014-54. I'm sure everyone out there is familiar with that.
I'm sure they are, Bryce. But this rule clears the way for people to save much money for retirement tax efficiently. We already talked about most people fund retirement accounts with pre-tax money, but funding with after-tax is becoming popular as well. Ruling 2014-54 says you can convert after-tax contributions to your retirement account to a Roth without paying taxes. You can make after-tax contributions after they've reached max contribution for traditional Roth IRA contributions.
Wow, that does sound great indeed. Wasn't aware of that one. Doug, that does sound good. In fact, I'm sure a lot of people out there want to hear more about that one. Do all employer plans allow these tax contributions?
No, unfortunately not. They're available to employers, but not required to be available. If you have any after-tax money in your 401k or some similar plan, once you can take a distribution of those funds, I strongly recommend you consider the basis allocation rules provided by Notice 2014-54 and make that a tax-free Roth IRA, not just withdraw your money. If your employer allows for after-tax contributions, this ruling can help save more money in retirement. There are procedures required to make the transition, so it's best to consult a financial and tax advisor.
And as we said, Doug, if anybody out there is listening to this and it sounds like something they'd be more interested in hearing about, they can give us a call at 336-391-3409. They can also visit us at our website and learn more about us. It's www.thewealthguardians.com. We have offices here in Clemens in the Triad area, and we also have offices down in Charlotte. And you've been in business for how long now, Doug?
31 years.
Congratulations, 31 years, and we're rated AAA with the Better Business Bureau,
Yep.
and have been the entire time. And we help literally thousands of people out hundreds of people out on an annual basis, but up to this point, we've helped thousands of people out achieve and accomplish the retirement dreams that they've set forth for themselves. So, folks, if that sounds interesting to you, again, give us a call, 336-391-3409. We'd be happy to help you out as well. And we appreciate you listening. We're going to go up against a quick break here. You are listening to the Wealth Guardians radio show here on WPTI 94.5 FM, the Triad's news, talk, and sports station. And when we come back, we'll continue our conversation on tax efficiency in retirement and how you can start preparing now. And welcome back to the Wealth Guardians radio show, where we help our clients retire the job, but not the paycheck. Welcome back, folks. Today's show is for everyone who doesn't like paying excessive taxes. So as I said before, if that's not of interest to you, then go ahead and change the channel. But I suspect most people out there would be interested in learning more about how not to pay excessive taxes. And we've been discussing retirement planning and tax-saving moves. Now, before we go any further, I do want to mention the tax planning report that is available on our website. And again, our website is www.thewealthguardians.com. Just go to the resources tab and download these reports section. There's a lot of other reports there as well, but these are all free, and you'll find a lot of helpful information. All right, the next tool to discuss is a favorable provision from the Pension and Protection Act of 2006. Doug, tell us more about that one.
Oh, folks, Congress finally did something for us, believe it or not. I love the Pension Protection Act of 2006. This is a great opportunity because Bryce, you and I, we just helped a couple both here in our Triad office and down in the Charlotte office. This is a great benefit for owners of a non-qualified annuity. That's an annuity that you have outside of an IRA. Because you can take that money tax-free for long-term care expenses. The Pension Protection Act, also known as Public Law 109-280, it has wide-ranging legislation signed into law in August of 2006. Most of this law deals with changes to pensions. Section 844 deals specifically, though, with annuities and long-term care. You know, folks, the Congress knew that long-term care and home health care was going to be a huge factor going forward. And they also know that Medicare doesn't pay for much of it and Medicaid is going broke. And they had to figure out a way for us to be able to provide for these expenses ourselves. Here's an example. Let's say you're a 65-year-old with a non-qualified annuity worth, say, $100,000 with a cost basis of $50,000. And withdrawals for any reason would be taxed over the basis. And the IRS says that the first withdrawals are always going to be your gain. So until you get down to that $50,000 of cost, then everything is taxable. It's taxed at your tax rate. It's probably going to make your Social Security be taxed even higher. So that same annuity, if 1035, that means that Section 1035 of the tax code means you can move it from one annuity to another annuity tax-free. You don't have to pay tax on that $50,000 basis. You can now put it into an annuity that has long-term care benefits. And all that money that comes out as a long-term care benefit or even a home health care benefit is totally, completely tax-free. Now, we just did this for a client here in the Triad and also down in Charlotte. Let me give you the background. This person, we'll call him Dennis. In August of 1993, he put $53,500 in a variable annuity. This was non-qualified money, after-tax money. Now, up until the time we 1035 exchanged it, which was a few months ago, it had grown to $165,998. So that's over $100,000 worth of gain. Now, number one, Dennis didn't really need this money. He had a pension. He was a fortunate guy. He had other savings. So the money coming out of this annuity, if he ever spent it, say maybe buy a car or something, was going to be completely taxable and probably force him into a higher bracket and probably make his Social Security taxable. So I said, Dennis, let's look at doing a tax-free 1035 exchange into a different annuity that can provide long-term care for both you and your wife. Now, that's pretty cool, isn't it?
Very
so
cool.
We did this. We took $165,000, moved it into a long-term care annuity that covered both him and his wife for home health care if needed, long-term care, or even skilled care if they ever need it. And guess what that $165,000 turned into?
What's that?
$760,000 bucket of funds that they could use tax-free for any long-term care, home health care, skilled care needs.
So they're quadrupling their money as long as they're using it for long-term care.
Exactly.
Yeah, Doug, we've helped a lot of people out with this, and I think it's safe to say that when we've brought this concept up to our clients, not one of them have ever been aware of this option. Nobody has said, yeah, I was thinking about that myself. They were all saying, well, I wasn't aware I could do this. Are you sure we can do this? And we show them that they can. And
well,
it's a great tool for them.
Our client here in the Triad was actually an accountant for the state of North Carolina, had no idea that this could be done, and his jaw dropped. And he said, this is a no-brainer.
Yeah, so. It is. There's no downside to it.
Yeah.
All right, Doug, let's talk about our next one, 529 plans and the tax savings that are available through them.
Yeah, they can really be a smart way to save money for a future education. And, my wife and I just opened one of these for our grandchildren. So what happens here is they allow tax-deferred growth and tax-free withdrawals as long as the money's used for qualified education expenses. Plus, in some states, you can actually get a state tax credit for your contribution up to certain levels. Unfortunately, folks, North Carolina doesn't currently offer that tax deduction, so maybe you want to talk to your representative. So rules and regulations that must be followed, but becoming a very popular tool for parents and grandparents, and anyone for that matter who has interest in saving or gifting money to their kids and their grandkids.
I would say that that's a good idea, Doug, to talk to your state legislature about it, but does the state legislature really listen to anybody anymore?
Yeah, that's a good question. I'm
So
not
I don't
sure.
I don't know, but that's not just North Carolina. That's a lot of states are now dropping that state tax deduction for that. So that's unfortunate. Okay, let's go ahead and talk now about our next one, the next tax advantage opportunity, life insurance.
Yeah, Bryce, I think you're on the money there. You know, people tend to focus on the death benefit side of a life insurance policy and what they're going to leave to a beneficiary, and that's good. You need to think about that, obviously. But certain types of life insurance plans offer a lot of tax advantages and benefits that people really don't even know about. This tool is widely used by very wealthy folks, but you don't have to be wealthy to take advantage of it. I'm sure you've heard of Walt Disney and J.C. Penney.
Heard about them.
Yep. You can qualify and fund these plans properly in certain types of life insurance and offer tax-free growth, tax-free withdrawals, and that maximizes tax-free money. Now, the reason I mentioned Walt Disney and J.C. Penney is they did this very thing. Both of them use life insurance cash value to help, in Walt Disney's case, fund his first Disneyland, and in J.C. Penney's case, keep his company afloat during the Depression.
Now, these are some pretty wealthy people, Doug. Are these plans just for wealthy people?
They're absolutely not. Anybody can do it. I mean, I've done one for myself and my wife, and I've done it for many clients. So, one type of plan are the pre-tax plans like your 401k and your IRA. In other words, the money is in all probability in those plans, what's left over is going to go to beneficiaries. And people who would work well are generally those who wouldn't take RMDs if they weren't required by law. And since they take these RMDs, they're putting that money to work in a specialized life insurance vehicle that maximizes the money for additional inheritance. Now, if it's structured properly, the way this life insurance policy works is the buildup of cash value over time you can actually take out via the loan provision of the policy tax-free to help supplement your retirement income. And you know what's cool about this loan, Bryce?
Tell me.
It's you never have to pay it back. You ever had a loan you never paid back?
I didn't know those kind of loans existed,
Yeah,
but
well,
I
this
would
one
love
does.
to learn more about those kind of loans.
This loan you never have to pay back because the reason is the death benefit when you finally pass away will pay off the loan, and then what's left over passes tax-free to your beneficiaries.
Well, just like I guess that people out there are interested in learning more about how not to pay taxes, probably a lot of them are interested in how to take out a loan that they don't have to pay back as well.
Absolutely. So if something like this has you curious and you want to inquire, just call us at 336-391-3409.
And folks, we do have more information on that as well on our website, www.thewealthguardians.com. Go ahead and visit us or give us a call, 336-391-3409. We only have a few minutes left, but we have time for one more valuable tax-saving strategy. Doug, why don't you explain what a QCD is, please?
Sounds like a quack. No, QCD. It's a qualified charitable distribution. And that's also becoming pretty popular for people who are 70 and a half and older and have those required minimum distribution requirements. This is a tool that you use to give money to a charity or, write a check to your church or synagogue. And what it does is it allows people to give money directly from their IRA to that charity without claiming it as income. And it could help, and it does help satisfy that required minimum distribution requirement. A lot of people are in a position where they know they got to take the RMD because if they don't, the penalty is pretty stiff. It's 50%, but they don't need it. Maybe they've got pensions, nice Social Security, and other means of income. So they're paying tax. So why not satisfy your charitable giving by just taking that RMD and giving it to your charity? Now, is a special way you got to do it. It cannot touch your account. It cannot come directly to you. It goes directly to your church, charity, synagogue, whatever, and it counts as your RMD, and it's also a charitable donation. So a QCD allows charitable donations, saves you some tax dollars, and meets your RMD requirements. So again, we'll invite you guys in for any kind of a free review of your current retirement situation and help you confirm that you're maximizing every tax deduction, tax strategy that's available to you. It's a free, no obligation, 4-step process. Let me tell you what we're doing here. We're going to have at least 4 meetings. Maybe it'll extend longer than that. But in our first meeting, it's a get to know each other meeting. You know, we're listening to you. You're asking us questions. We're gathering data. And we're going to analyze your accounts. We're going to analyze your Social Security. Our second meeting basically is one in which we've already analyzed your accounts. We're going to test your risk tolerance. Then we're going to look at the risk your account is under. Most people have no idea how much risk they have. We're going to show you the fees that you're paying, both the fees you know about and the hidden fees. And we're going to do the Social Security optimization for you. In our third meeting, that's when we bring you back in. We call it our draft plan meeting because that's where we put it all together for you. We show you the income plan, and that's where we ask your input. What changes do you want to make? Did we get this wrong here? Can we make this a little better here? We even do some game planning here. What if I retire today? What if I wait 5 years? That kind of thing. And then in our fourth meeting, that's when we put it all together for you in a written bound document we give to you. And then hopefully we pray that you become a client of the Wealth Guardians. So if you're interested in that, give us a call at 336-391-3409. It's free and there's no obligation.
And check out our tax planning white paper based on today's show on the website, www.thewealthguardians.com. And we'll be back next week, folks. It's been a pleasure talking to you all. Have a good weekend.